Okay, so this is the 2018 tax update for individuals and small businesses. Here is a little bit about me. 17 years of tax experience. I have a master's in taxation, and I am also a certified tax coach, and I do advanced tax planning. And I am also a mompreneur and a mom of 2 boys. And here's a picture of my little boys when my younger one was born. And this is what it is all about. Um, okay, so here's a little bit about the agenda. Basically, I'm just going to go over a few of the individual tax changes, business tax changes, eliminate section summary, kind of go over some of what is tax planning, and if this was a live recording, we would have a question period. Um, individual tax changes. This is just a summary of what has been not all inclusive by any means. It's basically highlights of the main things that will affect the majority of people. So on the left side, you see that this is the 2017 changes. These were the standard deductions that were allowable in 2017, and you can see in 2018 they are almost doubled. So you've got 12,700 married filing point in 2017, and now it's 24,000 married filing point in 2018. And HOH stands for head of household. So these just all relate to whatever filing status you or your taxpayer has. Um, the main thing that this is going to change is it's going to change the people that are able to actually get any benefit from itemizing at all. Because essentially what it is that if you have itemized deductions that are less than this 24,000 if you're married filing joint, then you would get the same deduction whether you itemized or not. So you're only getting a benefit to the extent that your itemized deductions exceed if you would have gotten otherwise this standard deduction. So essentially, if you have $25,000 worth of itemized deductions, you're only getting an additional $1,000 deduction because you would have got the 24,000 anyway. So that's how that works. So personal exemptions has been eliminated. So personal exemptions, that's where you are claiming, yourself, your spouse, your children, possibly a parent that you're taking care of. Exemptions on your tax return. This completely eliminated. So there are no more personal exemptions. So it's standard deduction, and then they did increase the child tax credit at as double. So if you qualified for that, there will be additional child tax credits that you get, and that's a per child deduction. Mortgage limit. This is also related to itemized deductions, and this is a big one that some people are still a little bit confused about when I talk to people. So this is the old rule. So the mortgage limit, so this is principal acquisition debt. So what you bought your house for. So if you had a mortgage of $1 million prior to 2017, or you bought a house, say you bought a house in 2017 for $1 million, you would be able to deduct all of the mortgage interest as an itemized deduction related to that $1 million principal debt. In addition, if you also took out a $100,000 home debt on your principal residence or your second home, and you've got the combined debt of 1.1 million, that would all be deductible mortgage interest debt as an itemized deduction. What happens in 2018 is they reduced that limit to 750,000, which also includes your home equity debt. So there's no addition on top of this. So you've got a mortgage limit of $750,000 of acquisition debt. And if there's any home equity debt included in this number, it's only going to be deductible interest if you use that equity debt for acquisition or improvements on your home or your second home. And one thing to keep in mind is that this is on new purchases only. So if somebody had a home that they purchased or prior, the old rule is still going to apply until they sell. I'm not sure about refinances. I would have to check that. So I would have to have a question for anybody. Let's see. I need to go back. Okay. So the next item is the state and local tax. So this is basically property taxes, income taxes. Um, those would be the primary deductions, and also includes your state income tax. If you're in a state like California with a high income tax, this includes all of that combined. So this is a big one that is especially going to affect high income states like California. Um, so previously, state and local tax was unlimited unless you were an AMT, and AMT is a whole separate discussion. It's essentially another tax calculation where you add back some uh, deductions and you calculate a tax based on another method, and that's a whole other conversation. So if you were not an AMT, you would get an unlimited deduction of the state and local tax. If you were an AMT, you would basically lose the deduction. Now, state and local tax deductions is limited to $10,000, so that's combined. So if you have property taxes of $6,000 and you paid, $100,000 in state tax, and you're only going to get $10,000. So that's another reason why there's going to be people that are going to no longer get any benefit from itemizing deductions, or at least a reduced benefit. Okay, so here's a highlight of some business tax changes. For 2017, corporate tax rate, this is to corporations, will have a corporate tax. So a C corporation prior, there was a scale of between 15% to 34% tax rate. For 2018, it is now a flat 21% tax rate. In 2017, bonus depreciation. This is basically allows you to write off a large portion of a fixed asset that has been acquired in the year that you buy it. It does have to be new property, and you do have to be the original owner of the property. Original use of the property has to be with you. So this was the previous rule, 50% bonus depreciation on property acquired before September 28th, 2017. There's some special rules on qualified leasehold improvements, which have to do with improvements on a building that you either own or you lease for your business. So now the new rule in 2018 is 100% bonus depreciation for property acquired after September 28, 2017. So the dates of things have been acquired and put into use is important in terms of bonus depreciation. And one of the main reasons that's important is because a lot of times tax preparers, are told, oh, hey, I bought a big piece of equipment, say a copy machine or something like that, and they don't really always get the exact date of the purchase. So it's more important for 2017, 2018 to verify, especially 2017 to verify when it was purchased because of this cutoff date. If it was purchased in the last quarter, then an additional bonus depreciation could be taken or could have been taken. And at this point, you'd be talking about amending tax returns. But just a note there. And then another big thing is 1031 exchanges are only allowed for real property now. So a 1031 exchange is the exchange where you sell a property and you buy a like-kind property. And instead of paying gain on the property that you gave up, you just adjust your basis of the new property. So you're essentially deferring that gain and not paying any tax, or at least paying minimal tax, depending on how you structure it. Previously, it was like-kind exchange rules. So it could be any kind of properties that was similar. So a car for a car, or a building for a building. So now it is no longer all like-kind property. It is only real property. So real estate, land, anything that qualifies as real property. So where that's important is especially, where I would see this possibly happening a lot, would be in a business where maybe you got a vehicle that was depreciated, could have been fully depreciated or mostly depreciated, and then is exchanged in for another vehicle, where previously that would qualify as an exchange. And so you potentially would have no gain on that transaction. Well, now that rule doesn't apply. So now you would have to record the sale of the first property and pay any gain if there is any, which there could be a gain on a vehicle because you've taken depreciation. The and then the second vehicle would be recorded and you take new depreciation. So you just have to be aware of that. That could be an issue. Second thing, well, the last thing for the 2017 comparison is the meals and entertainment used to be 50% deduction. The meals is still the same, 50% deduction. Entertainment is no longer deductible at all. And then there is a new 20% pass-through deduction that is a new rule, and that applies to pass-through entities. And that is called the 199A deduction, and I'll kind of talk about that on the next slide. So here is the 20% pass-through deduction, section 199A. This is a new rule, so this is for pass-through business activities. So this would be your S corporation, sole proprietor, partnerships. It's essentially any business, qualified business activity where the income is taxed on personal return. So it wouldn't be a C corporation. So there's some income thresholds. So these are the personal income thresholds. So for a married filing joint couple, if you have 315,000 to 415,000, there could be some limitation. So that's just something to keep in mind. First thing is to look at these income thresholds, and then you got to look at the fact pattern to see whether it will be limited. There are some specific limitations to specified service or trade businesses. So there's additional calculations required if you're within these thresholds and you qualify as a specified service trade business. So that would be anything where the expertise of the shareholder or of the business is basically the business. So you've got like accountants, and lawyers would be examples of that. So if you are on the upper threshold, so you're above this 415 for a married filing couple, or you're above this 2075 for an individual, and you're above these, and you're a specified service trade or business, there is no deduction. If you're within this threshold and you're a specified service trade or business, then there's some additional calculations that are required to determine how much you could get this deduction. I did insert a calculator here that can be used. I can show you this. It seems like it's a good idea. It's a good little calculator to just get a general idea. I would always, check with your tax advisor, or do your own calculation in due diligence before relying on this completely. But it does look like it's a pretty accurate calculator to give you a rough idea. So it has like the little drop down of single, married, and the basic fact patterns that are used to determine whether or not there's a limitation that could apply. Wages paid by the business, this is relevant because this is taken into consideration if you are within those threshold to determine whether or not you're going to get a deduction. So you put in your fact pattern, it gives you the 199A deduction, but what I like is that it kind of shows you all of the calculations, and then it shows you which calculation it's using to get this deduction, so that you could go back and check this fact pattern if you wanted to for planning purposes. What is tax planning? Basically, there's essentially three different kind of levels, I guess, if you will, of tax planning. The first one is just a projection, and that's basically where you're looking at what would happen if you did nothing. So you're basically just taking what usually there's a starting point of looking at the prior year, adjusting for what you know for the current year, and saying, okay, if we continue on as is and we do nothing, then this is how much we're going to owe. And so it's kind of reducing that sticker shock. There may or may not be a couple of things that are done to change anything. Could be maybe just avoiding penalties by making sure you pay your estimates on time. And then tax planning could involve maybe a few strategies, maybe like prepaying some expenses that you could get deductions for would be an example. Again, it could involve minimizing any estimated tax penalties. There's a wide range of tax planning, and it's usually going to involve one or two or three, maybe relatively simple strategies that are going to involve your existing entities as they're currently structured for the most part. And then you have strategic tax planning, which is more of a deeper dive type of tax planning where you go into your whole tax scenario. So you've got your personal tax situation, any business entities, any properties that you own, any investments that you have, your trust and estate tax situation. It's a more holistic approach of everything, and looking at everything and also in line with what your goals are, and coming up with a strategic tax plan to minimize your tax burden and not pay any more than you have to. And that is my summary. Thank you very much.